Look, it's been closed for a long time.
Yeah. But
So,
now we've just had a banking crisis. I mean, now going into 2024 here, is it happening?
Look, we're obviously we're closer now than we've ever been, right? And I don't think people should be pressing their luck. People should be preparing as if it was going to happen tomorrow. And if it doesn't happen tomorrow, then at least you're prepared, right? You got these people, preppers that are like, building doomsday bunkers, right? I mean, this is a little, not as extreme as that. I'm not going to necessarily laugh at the doomsday bunker. I may end up with my own, but this is a lot less extreme. But again, you can't build the doomsday bunker after the crisis.
After the doom.
it has to be in place and fully provisioned in advance. Mm-hmm. So you got to get your financial house in order. Because again, it's not a question of will this crisis happen? It's 100% certainty that it will. The only variable is when. Now, maybe you'll get lucky and die, before it happens, right? And then it's your kid's problem. But I don't want to bet on dying to avoid the problem. I want to be here. You saw all the equipment I've got to keep me young.
Multiple hundreds of thousands of dollars of.
I'm trying to.
You
survive.
were in it. How was it?
Very chilly.
Yeah.
Negative 124 degrees.
It's going to be real chilly in the financial world too if you don't have yourself protected. So as I said, you got my mutual funds, but people can work with me directly. They can come to my asset management company, which I'm still there. So that's SEC registered, not FINRA anymore. I'm SEC.
Because that's an investment advisor,
right?
And
not
we're fee-based.
A broker. Okay, right, we're fee-based. So I don't work on commission anymore. I just manage money for a fee.
Okay.
But I think we do a job that you're not going to find anywhere else in the investment community. No one's got the balls to manage the money the way I do. And they don't actually have the foresight to understand that they need to do this. But I think we're constructing and managing portfolios that are ideally positioned. I mean, if you would have had my portfolio in 1970 and you would have stuck with it through 1980, you would have just crushed it. Wow. I mean, you guys remember what happened from 1970? The dollar lost about 2/3 of its value against other currencies. The Deutschmark went from you got 4 Deutschmarks to the dollar to 1.5. You went from buying 360 yen to about 150. Oil went from $3 a barrel to $30 a barrel. Gold went from $35 an ounce to $800. Right? We went through this massive stagflation. It was a terrible economy, right? All these married women were forced into the workforce because their husbands' salaries were eviscerated by inflation and taxes. And so they had no choice. They had to go get a job. But the investments, certain investments, if you invested in Japan, if you invested in emerging markets, if you invested in commodities, you invested in oil, you invested in gold, you made a killing. Where did you get killed? If you stayed in U.S. bonds and U.S. stocks. Right? Wow. U.S. bonds, complete disaster. Stocks, in the 1960s, they had something called the Nifty 50. Right? These were stocks, they called them one decision stocks. The only decision is when to buy. You never have to sell because they never stop going up. Right? In 1966, the Dow was at 1,000. In 1980, it was still at 1,000, despite all that inflation. Despite the fact that gold went from $35 an ounce to $800, the Dow didn't go anywhere. That's why the real price of the Dow in 1982, I think, was at an all-time record low, or 1980, 81. It was almost 1-to-1. That was lower than the Dow was at its low point in 1932. It was actually the record low for the U.S. stock market was in the early 80s in terms of gold.
In terms of gold. 82 was also just in terms of dollar bottom, and then it was up like 40 years from there.
Well, in the early 80s, you wanted to sell all your gold and buy stocks, right? Now you'd want to do the opposite if the only choice were U.S. stocks, because you're looking, it's not quite 20-to-1, right? The Dow is almost 40,000 and gold's about 2,000. So it's close to 20-to-1. That was the peak in 1929, 20-to-1. Now, the all-time record peak was 2000. It was like 40-to-1. The dot-com bubble was the peak for the day, because gold was under 300. So we got about a 40-to-1 ratio. So we're well off the highs, but we're still in expensive territory. I think the Dow is going to come below 2-to-1. I don't know if it'll get all the way to 1-to-1.
And that again could be gold.
Yeah,
up.
yeah. Well, the same thing. So where would it be? So if the Dow is 40,000 and gold is 20,000, that's 2-to-1. But the Dow can go to 10,000 and gold can go to 5,000.
Why has gold been so stuck with all this inflation?
Well, you remember, gold went from under 300 in 2000 to almost 2,000 in 2011. Had a huge gain. Yeah. It's now moved sideways for a while, consolidated those gains. Yeah. It's getting ready for another big leg up. This is all going to smooth out. In 30 or 40 years, when you look back, you will barely notice this period of steady. When you look at gold at 10,000, 20,000, wherever it's going, because it has to go there. I mean, the dollar has already lost 99% of its value against gold. When we started on the gold standard, when the Federal Reserve was introduced, gold was $20 an ounce. It's now $2,000 an ounce.
That's a good point.
That gold hasn't changed. Gold is the same. The dollar has lost 99% of its value. You need 100 times as many dollars to buy an ounce of gold as you needed when we created the Federal Reserve. But the thing is, before we created the Federal Reserve, gold in 1800 was the same price it was in 1900. Because the dollar didn't lose value for those 100 years because we didn't have a Federal Reserve during those 100 years. We had capitalism. Prices were going down. So people should, they could come to my RIA, Europe Pacific Capital, and we could create a portfolio. Because if you stayed with the stocks that worked in the 60s, in the 70s, you lost your ass. If you were smart enough to make the shift out of the Nifty 50, out of the Polaroids, right? That was one of the stocks, right? How many people are using Polaroids now, right? Maybe as a gag item at a party, once in a while somebody will take a Polaroid, right?
Shift.
But everything that's new is old eventually, right? All the new technology is old. I mean, I remember, cassettes came and they replaced records, and for a brief period of time, I thought I was cool with an 8-track, and that didn't last very long. And then oh my God, look at these DVDs. Who has those? They don't exist anymore either. I mean, it's there, it's new, it's great, and then it's gone, right? So, but if you stay with, the stocks, that dominate the NASDAQ, these few stocks that everybody made money in, if you overstay that party, you're going to have massive losses, just like people did in the 1970s, probably worse. You've got to recognize, that the time to leave was yesterday. I mean, you can't try to get every last drop. There was a famous, I think, saying, it was who it was Bernard Baruch, but whatever, what was your secret to investment success? I always sold too soon, right? You can't try to get every last bit of a bubble, right? You got to get out, and you got to be willing to let somebody else,
I think we've got a couple final questions.
But let me finish the point. So you got to make this shift. And that's what my portfolios that I have now and I've been building are the ones that are going to do well in the next cycle, right? Not the ones that did well in the last cycle, right? They're going to get crushed.
I see.
Right. Invest for the future. Anticipate how the winds are going to change and where the pendulum is going to swing, and skate to the puck, right? Where it's going to be, right? And
shoot ahead of the running deer.
Yes, there's all kinds of ways to explain this, but people don't get it in the investment world. So I'm there. These portfolios, and they're still producing returns, positive returns, paying dividends. But in the long run, if I'm right, in the long run, maybe just around the corner, these are the strategies that you need to adopt.
Mikey, do you have a question? We've got H who has a couple questions. If he could jump in really quick.
You can
hop on in, H. You want to just hop in so you can listen to the mic? You want to switch really quick?
Let's switch seats.
Really, a couple last final questions here. Peter, thank you so much for your time. This has been wonderful. Yeah. But H, you've written down a few questions here. What do you got?
Yeah, so you mentioned China as the rising economic power. Pretty much, I think we agree that Bernanke and friends in 2008, debt monetization. They chose an inflationary route, and now we're having to pay for it. We're going to have to pay for it for the next couple decades. We don't know the exact timeline, but It's either it's like an inflationary bubble, it's a giant essential Ponzi, and the only way we could get out of it is a deflationary bubble, which nobody wants to do because all the inflation was in assets and all the rich people were in charge. It's no bueno. It's probably not going to happen.